Well, Scott, welcome to Business Spectator. Thanks for joining us. Now, when you come into a new business, new company like this as a new CEO, of course you review the strategy and the team and so on, and we'll get onto that in a moment. But I was just wondering whether you came into Transurban and said, hello, this place pays out more than 100% of its free cash flow in dividends. What's going on here?
Well, that certainly was the case when Chris Lynch took over, but Chris had changed that. So the board in the last few years has adopted a philosophy to pay out approximately 100% of free cash flow. So we're paying out all of our free cash flow, but not more than our free cash flow.
Well,
so
it was 107. I think it was 117% in 2012.
Yeah.
And this year it's
95%. It's 95. Last year was 95% of free cash. Or sorry, we're forecasting 95% of free cash flow. It'll be 95% covered.
That's what I mean. It's 95% covered. It's not
not fully covered. Well, we've been paying out more than, less than fully covered last year. So we were just 102, 103%, I think. And
it gets to what Transurban is. I mean, it's kind of a shovel for tolls to go out to investors, isn't it? That's what your job.
Well, that's what we like about it.
Your job is to just get this pile of cash from tolls and shovel it out to investors, right?
Well, that's right. My job is to decrease the margin of those assets and drive the efficiency of the margin, because there's a lot of asset there. There's a lot of capacity that's there that's not being utilized at certain times of the day, and there's a lot of things we can do with technology. So my job is to try and drive that margin up so that we can get more of that cash and shovel it out to investors. And we have this interesting position with our network where if government wants to do anything going forward and they want to expand the network, we're in a unique position to sort of leverage those assets to create those future cash opportunities.
Scott, I'm afraid I can never understand your model very well.
Sure.
And I think that's one of the reasons your share price hasn't matched other income stocks. You're a company that pays out all your free cash flow, and understand that. You've got $5 billion worth of projects in either going or in the future. And you've got debt in the parent company of about $3 billion, and in the various toll roads there's debt. It's about $1 or $2 billion there too. At what point do you stop paying all your cash out?
Yes.
And start reducing your debt?
Your debt profile.
When does that happen?
Yeah, so if you look at, we've got different, obviously, concessions, and the average length is somewhere out there, the 20+ sort of range. So if you look at some of the assets that we've handed over, like the M4, so we had to hand over the M4 back to the New South Wales government. So sort of 10 years before the M4 was handed over, we started to pay down the debt profile. So the cash coming up from the M4 was less than the free cash being distributed because it was paying down the debt. So when you get to that last sort of 10 to 12 year period of concession arrangement, you look at sort of then how you pay down that debt. So when you get to the end of the period, when you have no asset and you have to hand it over to the government, that debt's repaid. But we're a long way from when you look at our concessions. So in
CityLink, when would you start getting into that situation?
Well, we still have, out to 2035 or 32 on the concession, so we're a long way from that position.
So you're 20 years.
Yeah, but the other thing.
So in 10 years, you'd start to pull back your cash flow.
Potentially. But the other thing that we have with CityLink is, again, the opportunity like we've done on Southern Link Upgrade. We're looking at other projects with the Victorian government. It's easier for us to develop these projects and extend the concessions, as we've done on the M2. As we've done on the M5, when government wanted to upgrade, we extended the concessions for another 10 to 15 years.
But when you upgrade, you then borrow more money. So it's sort of,
Yeah, but our assets are also in different profiles. So you've got assets like CityLink that are coming in maturity. They're generating quite a bit of cash. You've got the M7 that's in a ramp-up phase, so it's still its early development. It'll start to generate more cash. So the thing that we need to make sure is we've got this balanced portfolio so we can continue to grow our distributions, which is what our security holders want. And then we have to make those decisions whether these upgrades or enhancements are going to add value over time, or do we return that cash to our shareholders. So distribution growth is very important to us.
That's a critical issue, isn't it, Scott? Because as Bob says, there's $5 billion worth of investment, and I think you're over the hump on that. So in 2 or 3 years' time, you'll have a big decision about whether you just keep shoveling cash even harder or whether you spend it.
Yeah, well, that's the decision we've got to make. And we've got some unique positions, like with New South Wales, we have an unsolicited proposal with the government there to do a negotiated deal. So over the, getting out into 15, 16, 17, we've got all these projects that we'll have start delivering, and they'll deliver major cash. So our decision then will be, does the next generation of opportunity make more sense from an IRR and future cash generation perspective, or are we better off just to return substantial cash to the shareholders? Because at some point, if we continue on this path, the balance sheet will create quite a bit of capacity. And the shareholders rightly will ask, well, once you return some of that capacity, if we can't find investment.
Is there a geographic dimension to that question you've got to pose to yourself? In Australia, governments, state and federal, seem to be capacity constrained in terms of debt. Does that mean that in that 2 or 3 year time horizon, you've got to start thinking about whether you actually want to become more global than you are, because at the moment you've got US operations?
Yeah, no, look, really our markets are the eastern seaboard of Australia and the North Virginia, the Washington, D.C. area. So, you know, one thing that we have learned is that leveraging the existing networks and playing in your backyard adds a lot more value than global expansion or looking at new markets. So we're very, very focused on those markets. We think we have the opportunity to potentially add value, and if we don't, then we'll look to return that money to the shareholders.
It is true. I mean, you talked about, you know, wanting to be more efficient, and that's your job, is to grow efficiency. But one of the ways of doing that is through scale.
Yeah.
And the question, I guess, is can you get scale without retained earnings?
We believe we can. So the scale of what our asset businesses are doing, if you look, we've just implemented a new system on CityLink for our tolling system, for instance. We're looking to potentially rolling that out to all our assets in New South Wales. So we continue to maybe have one back office instead of having 5 to 8 different back offices across the group. So we think we can drive the operation efficiency, and we think our scale is big enough in Australia. The interesting thing when you start moving to new markets, whether it's different outside of Australia, in the US or the UK, you have different concession arrangements. A lot of times those arrangements constrain you from how you can consolidate your businesses. Luckily in Australia now, New South Wales and Victoria are more open to how we look at consolidating some of our businesses. So in the case of New South Wales, we're able to now have an operating agreement for Lane Cove and M2 as one. Previously we had to have separate arrangements. So there is the ability through that business to create more margin efficiency and creates more cash to return.
In your biggest asset, CityLink, there was some excellent work done on the exit from the Melbourne City.
Yes.
But it was completely stuffed up on the entrance, which means that the city now has to build a rail link. Whose fault was that, and will you accept some of the blame for it?
Look, the original concession in the design was something that obviously was a long time ago. We're constantly in discussion with Vic Roads about how we can improve the efficiency. Right now we have an issue with the Balti Bridge and the West Cape Freeway.
But it was because the investment was absolutely wasted. It doesn't work anymore.
Well, I mean, we try everything we do that we can fix it. I can't take personal responsibility for it.
But your company can, though. Your company can.
Yeah, I think the original design, and as things evolve over time, which creates an opportunity for us to help work with the Victorian government to try and fix these things. One of the things that we're trying to do in a policy sense as well is, I think in the past some of these operators have tried to act as independent pieces of infrastructure. We see ourselves as part of the network, so the whole network has to function efficiently. We actually want public transport to work well. We want the other modes of transport to work well, because that frees up our capacity and our road to function well, and also frees up in the long-term future different pricing models. So again, for the efficiency of our road, when you're looking at pricing at a certain time and the same price applies, eventually, hopefully, if people have alternative modes of transport, public, that are accessible, we can look at making these roads more efficient, and we can solve some of these problems. So we're willing to work with the Victorian government and have done on the upgrade of Southern Link, and happy to look at other things to fix these problems. I mean, it's in our interest.
So you won't be
well.
claiming a
material
damages.
adverse.
No.
Look, it's not our interest to claim those. I mean, if they're going to do something that I guess is going to damage our security holders without discussing it with us. But so far, we've been working collaboratively with both governments to try and find solutions, because it's in both our interest. I mean, we're trying to solve these problems because that frees up our network. Our network, if it's in gridlock, we're not making money because they're not passing under the gantry, they're stuck.
So you must be the company itself, I know it's not your fault, but
yeah.
The company itself must be very disappointed at the failure of that important part of CityLink.
Well, there's always been room for improvement. I'm not going to use the word disappointment, but yeah, look, there's always room for improvement.
But you do agree with me, it doesn't work properly.
They can always be improved, yeah. But there's sections of the whole
network.
Face
it though, it's true, isn't it? Your predecessors got that wrong, and the city bleeds as a result.
Well, actually, let's talk. No, but that gets to some extent to the team. You've come in. Can you tell us a bit about how you found the team? Is anyone? Have you had to make any changes so far, and do you plan to make any changes in the future? Yeah,
so we announced today the new executive team, and we've made some announcements previously. So not big changes or wholesale changes, but a couple of things that I have done is elevated a couple of portfolios. So technology portfolio used to report in underneath the CFO, and there were 3 different silos of technology. So we had road technology, the corporate technology, and then sort of customer technology. That's all now reporting to me directly, and it's all being consolidated. Our delivery and operations was in silos under the assets. We've now consolidated that. So we get that operational excellence, best practice, and enables us to look at these bigger projects that might come down the road. So it's not a wholesale change, it's not additional overhead, but it's elevating a couple of portfolios reporting directly to myself. And I think a change in policy, we want to play a more active and leading role in policy, and we've got the federal election coming up where we can obviously provide some input on how these projects will be funded and how the private sector interacts. I mean, we particularly applaud the New South Wales government and their unsolicited proposal process, where we're able to actually have a discussion with the government about what we might provide that's sort of unique and deliver their plan. Whereas opposed in the past, you were just handed a piece of paper that says you must compete and deliver against this. And a lot of times we might not think it's the most efficient design or structure, but that's what the government has asked for, so you had to participate. Here we can sit down and have an intelligent conversation and maybe come up with some smarter ideas.
Scott, the hot lanes in Virginia are open. I know it's really, really early days, and so we can't draw any conclusions from the numbers. That dynamic pricing model, could there be an application of that here?
Yeah, look, we love the dynamic pricing model, and that road is the most technologically advanced in the world. And you know, if you look at it from I guess addressing the issues, it addresses public transportation, it addresses optionality, it addresses choices. We think it's a fantastic model.
Just to explain to the viewers, what we're talking about is differential pricing on lanes.
Yeah, so you have free lanes running aside tolled lanes, and the tolled lane price changes dynamically with the traffic on the free lane. So as the traffic on the free lane congests, the price rises on the toll lanes to maintain a minimum of 45 miles per hour in the free lanes. So the public transport that uses that for free, and high occupancy vehicles which have 3 or more people in the car, they use that for free. So it addresses quite a few issues. We think it would be very applicable to the Australian model. Under our existing concessions, we can't apply it because it doesn't allow for it. It does seem to address a lot of issues, but we haven't had a lot of luck with the politicians being brave and out on the front foot on looking at dynamic pricing. But if you talk to a lot of the bureaucrats behind the scene, they eventually see that those type of models need to bring efficiency.
And does it get consumer acceptance, or are they confused by the fact the price is changing even as they drive along? So
the consumers, I'll have to send you the YouTube link. There's a great YouTube video of some guy driving down there referring to everyone else in the free lanes as, I think he used the word chumps, because he was driving at 65 miles an hour for $1 and they were stuck in traffic on the way home. But so free advertisement on YouTube, so good on public media. So the customers have accepted really well. I think the issue that we're dealing with is a huge change of traffic patterns in the Washington area, because construction's been under for 5 years. And some of the customer survey work that we've just done, they're afraid that the price will change while they're on the road. But as soon as you pass the gantry and you see the price, that's the price that's locked in. So there is some concern, and we have some more education to do with our customers.
Along those lines, the congestion tax in London has, as I understand it, been very successful. Yes. Do you think that could happen in Australia? And if so, could Transurban be the collector?
Look, we think that long term that the network, again, as a whole with public transport and all these models needs to work. So if the government wants to use, and New South Wales is talking about distance-based tolling, so they want to move to eventually long term under their master transport plan to a distance-based tolling. Now that may even evolve outside of the network to even the feeder roads. And if they were to move to that, we have the technology and the capability to provide that operations if that's something the government wants to outsource.
So you're talking about, or they're talking about, tolling a lot of roads that are currently free?
Eventually, and looking at, I think in their master plan they talk about distance-based tolling on the main roads. So the whole issue of that long-term debate between you're raising revenue from fuel tax, and a lot of that revenue is going into general funds. Do you start making the transition so it's more transparent? The price you pay for roads is actually the price it costs to do roads. And I think eventually, you know, we'll have to get there, whether it's 10 years, 20 years.
Well, that's different to the congestion tax, which is a different, which is pricing the CBD entry.
True.
You could presumably do that.
We could do that as well if that's something they want to proceed. But I mean, the government so far made it pretty clear they don't want to do it. I mean, they do accomplish that in different ways. Obviously, the charges that are charged in Sydney for parking, the taxes that are raised on parking, it kind of works as a congestion charge.
Scott, there are a lot of, around Australia, particularly on the East Coast, there are a lot of road type projects that are in the pipeline.
Yes.
How do you believe these will be funded? Do you think we're going to raise a lot of equity? Do you think Transurban will use its equity base to do a whole lot of them? Obviously some will be done purely by government, but let's assume the private sector is going to be used. How is it going to work?
So look, the government's got, between Sydney and Victoria, if you talk about the plan here, there could be $15 billion worth of major roads that they want the private sector to look at, and there's the other government roads as well. Look, there's a huge appetite out there from the unlisted global infrastructure sector. It's a massive wall of money. You look at still how they compete overseas for brownfields assets. So there is a lot of capital out there, but the equation has to be structured correctly. And this greenfields traffic risk that scared and caused so many problems in the recent transactions has to be addressed by how government goes about the structure. So there's different ways to look at the structure. So I think there's a lot of equity capital if it's structured correctly. We have some of those capital partners are actually investors in Transurban, and we have a lot of super funds who are investors in Transurban. So we could be part of that equity equation as basically a funnel for super and infrastructure money. And there's a lot of unlisted money, and we work with them as partners. Probably the biggest issue is more on the debt side, because we don't have a long-term debt capital market as we do in the US or the UK. Funding them from a debt perspective actually makes it a bit more complicated. I think there's a bigger appetite from equity than
Have you ever thought of offering Transurban debt to your own shareholders?
No, it doesn't.
Why not?
It doesn't give us the return that we're looking for.
The rates are too low?
Yeah, the rates are too low for us.
Okay.
But I mean, the problem with the greenfields projects in recent times has been investment bankers coming out with traffic projections that were far too aggressive. I mean, you just need to come up with sensible projections of traffic.
And I think what will happen is you'll have the first couple of projects, and again, some people would say, look, we have our own network traffic modelling people, and we have our own team internally. And one of the reasons Transurban didn't participate in the last round of toll roads was because of that. They couldn't compete because they had a different view on traffic. So
well, your view was right.
Yeah, our view was right, yeah. So now we're in the position that, when everyone's afraid to take traffic risk, is probably a good time to take traffic risk because you can be realistic and you can look at it effectively. But what we try to do is leverage off our existing network. So when we build an extension or a new ramp or an upgrade, we're actually leveraging off the brownfields traffic and not essentially taking all greenfields risk.
There are a couple of very new projects in Queensland that are in strife. Is that an opportunity?
Look, for us, we like that network approach. If you look at Sydney and Melbourne, we've got surface roads, very long roads with lots of optionality, lots of connections. The issue for us with River City Motorway and BrisConnex, which I'm assuming you're referring to those two roads, is that they're both tunnels and there's little expansion opportunity because they are tunnels. They're small connections, even though they're big capital-intensive projects. So they're expensive to operate. They're actually not very long, and there's not a lot of optionality. So, QML is a very interesting asset in Queensland because it looks the same as a CityLink or our Sydney network, but the River City and BrisConnex are not at the top of our list.
One of the issues that's bedeviled Transurban throughout its history has been that the North American pension funds have a very different view and a longer view of value than the Australian institutions. Is that changing? Given what's happened post-GFC, are the Australian institutions getting their mind around the fact that these are CPI plus long-term cash flow streams?
Yeah, look, I mean, if you look at, I think the answer is yes. I think for the big ones, the future funds and the uni-supers and the QICs, I think the answer is yes, because if you look at the competition overseas, those funds are competing quite aggressively against those North American, Canadian, and Asian sovereign funds overseas for infrastructure assets. But there's still a massive group of super funds that isn't participating in an unlisted way, but we're happy for them to participate through Transurban, where we can provide liquidity and the expertise, hopefully.
There's a huge, I think what Abbott plans to do is use the self-managed funds.
Yes.
Because that's where the money is,
Yeah.
and they want to invest in infrastructure. And there's, I don't know how many tens of billions there's available, but it's more than you can provide.
Yes,
it's
absolutely.
all there. The big superannuation funds don't understand it, except the ones you mentioned.
Yeah.
But that's the market.
Yeah. Well, look, again, they can obviously invest through a listed entity, which provides them liquidity and hopefully that expertise. So we do hear a lot from government, we want to tap the super funds to fund these. And we sit there as Transurban and go, well, we're ready, you give us the project. I mean, it still has always been more a lack of quality projects now and opportunity than not the capital.
We'll have to leave it there, Scott.
Okay.
Thanks very much.
Thank you.
Thank you, Scott.